Hello and welcome to Financial Statement Analysis Lecture 9, Part E. This is a conclusion to our valuation models that we've just discussed. We've now looked at 4 valuation models in detail. The dividend discount model, then derived from the dividend discount model, we had the residual income model, also called discounted abnormal earnings, the residual operating income model, also called discounted abnormal operating earnings, and finally the discounted cash flow model. So all 4 of these valuation models that we've looked at derive from the dividend discount model. So there's going to be some similarities in them because they're all derived from the same place. However, there are some important differences that we have to take into account. They all focus on different issues. Those issues help with our forecasting. If we're going to do a dividend discount model, we spend more time trying to forecast the dividends. But in reality, most people, when they're doing their forecasting, are going to try and spend time forecasting a company's earnings. So in that case, the residual income model or residual operating income model are more aligned with what analysts actually forecast, future earnings of companies. If we don't trust the accounting of a firm, but we do trust their cash flow statements, the discounted cash flow model allows us to take away some of the complexities of accounting while still having a decent valuation effort. The 4 models require slightly different structures. They require slightly different forecasts to be made, and they have different implications for terminal values. The dividend discount model, when we did a terminal value, there were 3 choices. For a company that's going to continue operating and growing if the economy keeps growing, we would expect the dividends in the future to keep growing. However, when we went to the residual income model, we had those same 3 terminal value choices. But we said because residual income is not just if our company is going to continue earning profit, but if the profits the company earns will continue to grow above and beyond their cost of capital. So residual income growth is much rarer than dividend growth. So the way we implement our terminal values under the different models is very different. Similar story between the residual operating income model and the residual income model. Growth in residual operating income is much rarer. We would expect a company that has a very strong competitive advantage that can't be competed away with industry averages or industry pressure. The dividend discount model and free cash flow, for a normal growing company, we would expect growth in the terminal values because it just represents growth in the firm. So if the economy is expected to grow and our company is sensitive to the economy, we would expect dividends or cash flows to grow. Whereas residual or abnormal earnings don't necessarily grow at the same rate as the economy. Because we've learned 4 different valuation models, we need to understand the advantages and the disadvantages of those models. This research paper looks at a comparison of dividend, cash flow, and earnings approaches to equity valuation. And they've got some interesting findings. They said, this paper contrasts dividend discount techniques, discounted cash flow analysis, and techniques based on accrual earnings. That is our residual income model. So this paper's comparing the different valuation models on a wide range or a large sample of companies and checking which ones are going to be the most accurate. They find that valuation errors are lower using accrual earnings techniques rather than cash flow and dividend discount. The accrual techniques are the residual income model or the residual operating income model approaches. Valuation errors are lower, so that means the valuation estimates are more accurate when you use the earnings-based approaches. And the paper goes into more detail about when this actually is more likely to occur. Valuation errors are lower on the residual income and residual operating income model because we're taking into account the value of the company's balance sheet. So we're getting a good starting point. Less weight is applied to the model's terminal value because we're already taking into account the value of the assets on the balance sheet. Another paper looking at the residual income model in a lot of detail finds that our implementation of Olson's model, which is the residual income model, provides only minor improvements over existing attempts to implement the dividend discounting model. Okay, so they are finding there's some improvements with the residual income model, but only minor improvements over the dividend discount model. So again, there's some small evidence that residual income model is better than the dividend discount model here. And they go into more detail about when that is the case in the paper. The final paper that I want to show you is reconciling value estimates from the discounted cash flow model and the residual income model. And this paper, as far as accounting academics go, was, I think, controversial at the time when it was published, because these authors said that when you're applying a cash flow model and a residual income model, Because they both derive from the same dividend discount model, you should get exactly the same valuation. Now, when I've applied my valuation models on Gale Pacific for the spreadsheet examples, I've got different price per share estimates using the different models. What this paper says is, in practice and in research, they frequently yield different estimates. So when I've applied these different valuation models, I've got different share price estimates from the models. These authors argue that when you apply the models correctly, you will get identical valuations for all firms in all years. So maybe in week 11, if we have time, I'll show you how I can change up my valuation models a little bit and make sure with careful application of them, we can get the dividend discount model, discounted cash flow model, and residual income models all providing the same price per share estimate. Because they're all derived from the dividend discount model, if we apply them carefully, we should be able to get the same valuation. However, in practice, when people are actually applying these things, we often make a few shortcuts along the way, and that's why we get different valuation estimates. Those prior papers have showed when those common shortcuts are made, the residual income model is often more accurate than the dividend discount model or discounted cash flow model. So it does get a little bit nuanced in how the different valuation models are applied, and if you do get different answers. So we do need to know the advantages and disadvantages because they often apply to the practicalities of implementing these models. So to conclude this week's lecture, or to conclude the prior two lectures, we now understand how to value a business using dividend discount models, residual income models, the residual operating income model, and the discounted cash flow model. We also did price multiples as well. So we've got 5 different ways to value a business, 4 of which are formal valuation models using present value techniques. You need to apply these 4 models in your assignment, and you will get different valuation estimates when you apply the models. You need to take into account the advantages and disadvantages of the different models and think about which model is most likely to give you an accurate estimate for your particular firm. And that will be the one you sort of discuss the most in your assignment. So to get a good assignment going, you need to apply all 4 models. Then you need to think about the advantages and disadvantages of the models specific to your firm and make a judgment as to which model you're going to trust and make your recommendations based on. You'll then know that there's going to be errors in there and do sensitivity analysis. Maybe work backwards from the actual share price to see what forecast assumptions you've made that are different to this share market and how the price that you estimate and the share price could be reconciled. That would also be something that you can do. Next week, we're going to look at the cost of capital, the cost of equity capital, the cost of capital for debt, and the cost of capital for the firm. Once we understand how to do those estimates of cost of capital, you'll be able to completely finish all your evaluation work and finish your assignments. At this point, I recommend when you're doing these 4 valuation models, for your cost of capital, just put a number like 10%, but in your calculations, always refer back to that cell. So when you learn how to calculate the cost of capital correctly, you can update that one cell and all your valuation models will automatically update. That'll mean that you can get started on your assignments now, have it all finished, and then after next week, just change one number and things will click into place for you. Thanks very much, and I'll see you all next week.